I'm happy to do whatever.
All right, here we go. Welcome to Benny and the Squirrel. We have my buddy and partner at Wall Street Beats, Jeff Macke, Mr. Retail. We thought it'd be a good time to check in on the consumer and retail. You know, everyone's talking about AI and talking about all these other things. Let's check in on retail. And how's it going, Jeff? Welcome back.
It's going amazing. It's so good to be back. It's honestly, I've been pushing kind of in a subtle way. You know, I'm not a child of Donald Trump. I don't have that kind of influence, but socially I can kind of tilt things. And so I've been pushing for a longer and longer Christmas season every year. And finally it's been socially accepted that now the holidays pretty much start in August. My wife just called me from a home goods store and she said they have the Halloween stuff up, but that makes sense, right? And I didn't even tell her. I was like, that's 2.5 months away, which is, you know, like the fifth of the year, but sure. Yeah, I guess we can start decorating for Halloween. It's beautiful. So more and more spending, the consumer's kind of fine. And no one's talking about it. To your point on the AI and stuff, like literally no one pays attention to these companies, these names, because the consumer's kind of been given up for dead. And if you've been given up for dead, all you gotta be is a little bit not dead. And man, like on a percentage basis, you're aces. Like that's great.
Yeah.
Look at them; they're not dead. I mean, I have you seen Kohl's lately? Kohl's is like on a screaming rally. I don't have a position in Kohl's. It's a weird Wisconsin company that smells like mold. That stock is absolutely on fire every single day. And the entire investment thesis is they aren't dead. Go figure, they stayed alive. And that has been good for like 60% over the last 3 months. That's, you know, if it was an AI stock, you'd want to trade it. And so I'm just living in this weird world where it's just me and the trolls all hanging out in stores. And the moves are huge and no one's paying that much attention. Everyone's just tied into their American consumers are super negative and no one's buying anything. And I'm just buying IMAX because it turns out people are going to $35 movies like in record numbers. It's selling out for months at a time. And I'm reading op-eds about how no one's going out anymore. To me, that's just, you know, they don't ring a bell at the bottom, but they print op-eds like that. And so it's been a really nice couple months.
Yeah, so what are the macro guys? So what are the macro guys missing, right?
I think the gas prices thing threw them off a little bit. There was probably, you know, there was a huge crunch from that, but also there was a little bit of a Trojan horse, you know, just to keep it topical.
Bit of an Odyssey joke.
Exactly, very obscure one. Thank you for picking up, Scroll. You're so well educated, but the you know, it's the idea was that kind of things that were just going to fall apart, and it's been this impending disaster for the last couple of years for anything in consumer, particularly discretionary. You had tariffs matter. That was kind of last year, and then we declared a war, sort of out of nowhere. Those are both really bad for margins generally. You know, the textbook says get the hell out. You know, anything discretionary, anything retail, just get out. They've managed to protect the margins. You can argue about prices. There aren't a lot of perfect indicators of what inflation is actually doing, but for whatever reason, consumers have been showing up and it's kind of across the board. And so the whole K-shaped economy thing, which is classic, like I'm overthinking the macro and missing every trade available type of thinking, was, you know, the rich are spending more and the poor are a disaster. That's collapsing into just the consumer isn't great, but he's fine. And fine is good for about 25% more. And that's good enough for me for a year.
So, you know, when we look, we had you on sort of at the absolute, you know, most negative point on the consumer, I think, right after the government shut down and we had that fall sell-off. And then you got a pretty good rally until, you know, maybe call it the end of January. And, you know, it's basically, it's in line, you know, it's down a couple hundred basis points, the S&P 500 retail. And I think to your point, that only includes the top 10 retailers. So, you know, some of the stuff you're talking about moves a little more, but in general, flat. But, you know, you've talked about there's some really good stocks within that. And this is a tough slide, but if you look at it, one of the ones you've been on is Victoria's Secret. It's up almost 70%. And Target, and we'll talk about some of these, but that's a lot of 30 to 50% stocks up for a sector that's flat, more or less, right?
And Benny, what's crazy about these, or what's opportunistic, I don't know, you don't want to kind of pee in someone's Cheerios by calling them crazy, but I talk to a lot of smart people who I respect who are short a lot of these names. And it's kind of like, honestly, in a tape where the S&P makes new highs weekly, you're shorting stuff that's trading at like an 18 times forward PE at 0.6 times sale. Like there should be better names. And so you see things like Cheesecake Factory, which was fine. And that was good for 10 points. And then just everyone being shorted was good for another 20. And
it was one of those. Just I came out of that quite soon, but yeah, I mean, for me, the fast casual dining guys have been a really happy hunting ground for short since middle of last year. But very few of them are still working. That's for sure. Apart from Chipotle, Wingstop, Shake Shack, those are still working. But some of the others, certainly the sort of the family dining ones, like Cheesecake, like Cracker Barrel, have actually all broken out.
Cracker Barrel is up huge and absolutely lugging the whole sector around like crazy. Between it's Cracker Barrel and Cake are absolutely carrying the group. But for the most part, what you've seen, we saw good numbers across the board this week. We saw Chili's, Brinker Eats. They posted great numbers right after Cheesecake Factory did. Now, whatever your thesis is for the consumer is dying and no one's going out to dinner, those are pretty different restaurants. Those are pretty different. One is like have a triple. It's $5.30. We've got the happy hour special. Chili's is a fairly casual, super casual. The tabs are about half price, but they both came in with really nice comps. And almost you couldn't really tell the difference between the two. These are hugely different concepts that to me says that the consumer kind of across the board is spending. Now, does that make sense? I don't know, but I kind of pay attention to what people do and not what they say. And this has been a really good year to do that because people are super angry, but they're comfort shopping, I guess. I don't know, man, but they're going out to Cheesecake Factory and they're going out to Chili's.
I think there's a real problem with consumer sentiment surveys that has been the case for about, frankly, 10 years now. They've basically become political polls in disguise. And which is weird, right?
And no one really pays that much attention to it. And it's not like the U-Michigan survey, which everyone considers the gold standard, went from 100 to 50 on average kind of during COVID and never came back. Your survey is broken, good sir.
Yes.
I didn't take your PhD. I was just a psych major. I didn't go to the next level, but it seems like you're asking the wrong questions. If you honestly think that this is half, people are twice as negative as they were during the great financial crisis, because that's simply not the case. That I don't know. It's however you want to read the data. I kind of don't give a shit because I go to a store, I try to book a movie ticket and I've got to do it 3 days in advance if I want to see it in a decent theater. That's not how consumers behave when they're really stressed and really afraid. So the surveys are broken. If your consumer sentiment's bottoming in an environment where people are going to both Chili's, Cheesecake Factory, and spending $1 billion to go see the Odyssey, which, to be honest, what the hell? Like, things can't be that bad. They just can't, which seems like a gross oversimplification, and yet it's investable and it's conventional wisdom, and that's kind of how I make my living.
Yeah. And, again, when you buy stuff that's left for dead, it is always, there's a positioning aspect to it, right? We live in this long, short world where, the biggest players have both sides kind of covered. And you got to find a short for a long, and these have just been easy mental longs, and then it's not as bad, and to your point, you get 20% on top of what it would be in the old market that wasn't so stretched, right? And again, that's also a function of extreme crowding into one area of the market, right? And we don't need to go into that, but I think pretty much everyone knows everyone's in the AI, semis, memory, like that has been the dominant trade. And so it's at the expense of something else, more or less, right?
This is cigar butt investing. I mean, these are really small companies compared to the ones you're talking about. And so if there's a flow out of AI, it's got to go somewhere. And if they're going to go buy Target at all, that's going to move Target quite a bit because it's, 60 billion versus several $1 trillion. Like, these rebalancing events obviously favor sort of these beaten down companies. But again, that makes them pretty good because there's reasons to be more fearful of the parabolic moves that we're seeing in some of the, the classic chip companies. Benny, you and I have been around long enough to see kind of how this goes. If it was economically rational to, if it was sustainable to have option or profitability like that on chips over and over again, people build more factories. It's not economically sustainable, and they're pricing the companies like it is. It's not super complicated economics, but I don't want to be in that snake pit. I just want to bet on how the consumer's doing, and the consumer is just showing up. It's the best box office we've had for years. Simon Property Group's reports, it's a great number, like ridiculous numbers that you wouldn't. $850 same store sale, or sales per square foot. That's a crazy number. Even accounting for inflation, Simon Property Group telling us that what they're seeing in their malls, that the same store sales are $850 on average. That's huge. Up 13% year over year. Like, they're not that good a mall company, and they couldn't be. That's not just all inflation. That's just people going out shopping. And again, people don't shop when they feel economically scared.
I heard that Gen Z's getting into malls, though. They're doing all the stuff that they felt they got robbed of all the fun Gen X stuff that we grew up with in the old world, and that malls are one of the beneficiaries of it. Is there any truth to that?
I don't know, man. You're like 8 years younger than me, so I saw your generation take over, and all of a sudden there's a bunch of think pieces in the Times about just crap that's obvious to me. Children, kind of a pain in the ass. You see that when your kids are like 10. It's like, yeah, they are. Yeah, that's a good op-ed. So yeah, there's all kinds of, turns out it costs a lot of money to own a house. That's how you can tell the next generation has gotten in control of the editorial board of your New York Times, because that's sort of a timeless observation. I don't know. I mean, people stay the same. I don't think there's huge trends. I think consumers have always liked a better experience, and that's why you see such a dispersion among again, to go back to the theater example, it's not a huge sector, it's not a huge segment, but theaters given up for dead in general. The answer is sort of like McKinsey interview obvious, so give people a reason to get the hell out of the house. Like, what you're competing with is them streaming something on Netflix where they can sit on their couch. So make it nicer than that. It's more fun to watch a comedy in a crowded theater than it is to watch it alone with the wife or whoever. And so you see the luxury theaters that are up, literally they've doubled over the last year. IMAX, along that mask, there's that the pride of Wisconsin, Ben. We found a Wisconsin company that does luxury theaters. It's up 100% for the year. I mean, they're huge. AMC's flat because there's the economics on the downside remain terrible, but the consumers are willing to pay for a better experience, and they have enough liquidity to go out. If everyone's expecting a recession, as they have been, just being okay is that represents a beat. So the bar's a lot lower.
So in terms of back to the retailers, I think the cinema story is really interesting. But back to the retailers, how easy is it to unpick some of these tariff rebates into the numbers? Are we seeing those flow into this quarter? Or is that something we should expect?
Kind of just looking past it, they'll be for sure in the numbers, and they'll be for sure taken out of it straight away. That's been the big adjustment over the last 2 years.
Come on, the street right now is happy to put a multiple on marked up gains on Anthropic and SpaceX when they're looking at Google. So you really think they're not going to put a multiple on tariff rebates? Come on, Jeff.
Yes, because I live in a universe where work backwards from, if you have infinite monkeys typing forever, they will produce Shakespearean plays, and then just kind of come up with, okay, if you have 10,000 people covering every AI company, they'll come up with kind of decent research. And then there's just 20 guys like me following the consumer companies who, are coming up with any ideas. The work gets a little sloppier as you go lower, but it's I think that it's not expected. I think that there is actually some surprise built in here that there isn't in sort of the Anthropics and the rest of the world. And that is, again, people don't pay that much attention. You would think in a market this attuned to AI, Simon Property Group owns 11% of the malls in America. Simon Property Group makes shit malls. Just to be blunt, they just kind of tack these Lego fixture kind of stores on the end of stores. They're kind of garbage, and they're the numbers a little noisy. But if they're saying that comp store sales are that strong, of almost 14% year over year, and you own 11% of all the malls in America, the narrative, it's really easy for people to say, "Oh, I went to a mall and it was not crowded and it was empty and whatever." I don't care if Simon Property is producing a number that huge just by kind of keeping their malls fresh and doing the bare minimum. The consumer is sort of fine. And if the consumer is sort of fine, there are people betting a lot against that. And so I want the other side, and so it's always a matter of who's winning, who's losing. But that's kind of something that you can tell if you go to the mall, if you pay attention to the comps. This year, what's been interesting is you saw it with On Holdings. They reported the other day numbers that honestly Nike would sacrifice their children to achieve. I mean, just insane. 23% growth year over year. And it's just bonkers growth. The stock got eviscerated. It's if you're counter trend right now, if you have a huge multiple, it's super hard to maintain. The consumer's not strong enough to do that. But if you're a turnaround story, as we saw with Cracker Barrel, as we saw with Cheesecake Factory, as we're seeing with Target, you get a lot more latitude. People are looking for a reason to kind of not invest in stuff like Walmart. Walmart looks like a train wreck. Walmart has a shit kind of stock chart is terrible. The multiple is kind of indefensible. They report I think next week or the day after Target actually. And so we'll see if they're able to come up with something that justifies what is still at 30 times earnings. But you have a lot of companies that are 10, 15 times earnings. Again, things aren't that bad. If the consumer's coming in, it's really hard to bet against this group. There's better shorts out there, and that's at least the beginning of a long idea.
What's interesting when you look at that, because it looks like earnings expectation from Walmart pretty much flat for the year, more or less, or even longer, like flat since last summer. And the stock's done okay, but that if you go back to then, remember, and especially the spring, early summer of 25, Costco and Walmart were kind of like the only game in town because what you said, everybody else sucked, tariffs, blah blah blah, and Costco's been flat as a board for a while, right? So and Scroll would tell you those multiples are so high. Maybe they're just kind of like growing into their multiple, that they were ahead of themselves, maybe a little bit.
Completely. And you have a lot of trapped longs in those, and those have been companies that have been huge kind of generational wealth sort of. If my dad wouldn't have been such a dumbass and just put $10,000 in the Walmart and Costco IPO and left things alone forever type of stocks, we'd be rich forever. But if you look at them over time, they do have to consolidate a little bit. And so I don't think anyone is expecting great shakes from Walmart this year. But if it was easy to hold really long-term winners forever, everyone would do it. And there'd be a much smaller audience for shows like this trying to tell people how. Walmart it's not really defensible. We've talked about this before, Benny. I own it. I'm long in taxable accounts, which makes me trapped as a son of a bitch. So it's like, do I think it's going to fall apart enough that it's worth selling and just giving California and the US government 50% of my gains for the privilege of having me invest there? Not really, and that just kind of leaves you stuck. There are other opportunities, but it'll be interesting to see how kind of people swallow that Walmart expectation. We've heard from Amazon already. Their physical and digital retail was great. Like it's the stock is doing what it does pretty much every quarter, which is, when they beat anyway, it spikes and then it just kind of gives it back, and Bezos sells a bunch and people wonder why. And meanwhile, he's running around like literally Odysseus, just with his wife, the Valkyrie, and buying yachts and just doing crazy shit. It's like, yeah, that seems like an expensive lifestyle. That seems like a reasonable reason. So he's buying a rocket ship company and building a 300-foot yacht. That makes sense. That seems like it would cost a couple of billion. I don't know, but it caps the stock and people sell it off. But we'll see. What Amazon did do was set a standard for what kind of the comp number is, and that's about 4%. You're going to see that as sort of the bogey over this period. And the reason third quarter earnings, it's I'm always a little overexcited about retailer earnings, but the reason this one matters is back to school sets the pace. It's kind of axiomatic that as goes back to school, so go the holidays, and so go the entire year. I mean, and that's sort of what the retailers are looking at. Their forecast really matters here. And if they see the customers coming in, and if they're going to spend a lot of money on Halloween, they're sure as hell going to spend a lot of money on Thanksgiving. And then they're going to come in for Christmas. Now you have low expectations, low multiples, meeting a growth story that's kind of compelling. It's Target's discretionary has lost $6 billion of revenue over the last 4 years. That's a lot. That's 5% of the total revenues of your highest margin product. They can fix that. So, that presents a fairly bullish scenario for a company that's still at 20 times earnings, where it's if you're going to fix that, I don't need tangible numbers now. I need a clue. I need you guys to actually have a good explanation for how you're going to fix this. Hiring Isaac Mizrahi and bringing him back and just fixing it aesthetically is great. The traffic is better. I'm not sure how the market's going to react. Owning that stock makes me both super happy and terrified, which is how anyone should actually react if they've done this for more than 20 minutes. But it's we'll see. I'm not sure what the reaction is going to be to earnings, because clearly some beating is kind of built into that stock price, but the price action is great. And I think people are just discovering the story. I mean, Bank of America reiterated this and underperformed.
That's a chart that the squirrel could not chase. I mean, what says the double since Thanksgiving last year, right? I mean,
yeah, when we had Jeff on last early December, late November, I don't remember what it was. I had been overwriting calls all year on Target, and then kind of like Jeff was like, all right, I think that's it. And you got new management, and they kind of started turning around. But I'd say, and we can go to this next, Jeff, about some of these stocks that have worked in retail. How do you handle these earnings? Because if you look here, the orange and the blue are 27 and 28 earnings expectations. Well, this stock back at 155, it's where it was in 24 when, Street had it earning $12 or, around $12. They got some wood to chop there, right? So they better say the right things and put the right numbers up. Otherwise, you could get a step jump down in the stock.
And bound because they hired within. And so it's whenever you hire within and a company is so clearly broken, that's, it's a definitive red flag. Did the board really vote for the exact same strategy? Is that what's implied here? It turned out they didn't. Fidelki, the guy who took over, is actually really astute. He made some key moves early in terms of kind of cleaning out the board, some of the fights that Target got in, the cultural wars, all that garbage. If you're a national discount merchant trying to appeal to people across the entire country, your political stance is we've got affordable products that, will last longer than you would think. That's your entire politics. That's all you care about. Are you kidding me? They had people who disagreed with that were actually influential in the company. He got rid of them right away. That was your first sign that this is a good CEO. Benny, you and I have talked about a number of times. If you get a CEO who Wall Street trusts a little bit, who has a good narrative, who's regarded as a good operator, you can get a nice amount of runway without actually putting up the numbers. So I'm not really worried about the EPS there, because I know fixing Target is going to take a while and it's going to cost some money, but they can make a lot more money. Again, they've lost $6 billion on discretionary over the last 4 years. That's probably 40% margin business versus selling groceries, which is like 3. So, the turnaround
What
story kind
categories
of
have they
levers
really?
nicely.
What categories have they really missed out on?
They've missed on fashion. They used to be squarely like they were TJ Maxx. TJ Maxx has ripped off Target's entire mojo, which is just you come in here and you're shocked by kind of how nice this little dress is that you can buy for a price that you would never expect. Target was really kind of the leader in that. That's where all that Target crap comes from. Is that, people it was just a little fancier than folks would expect. But that's nice because it respects the customer. And in retail, you can do really well doing that. Once you tie that in with politics and all that other noise, it not by itself makes the shares a sell, but that kind of decision-making process illustrated a lot of their mistakes that were being made at a corporate level. Fidelity, as a lifer, it comes with pros and cons. The initial reaction to him was sell. He's been part of the problem all along. But if he's actually a sharp guy who's been sitting in the background the entire time, kind of seeing all the parts of the company that he can fix, there's a lot of low-hanging fruit. And he can fix those companies right away. And I don't know how earnings are going to be. I'm not positive what revenues will be. I know comps will be better than expected, or at least I strongly believe that, and I do this for a living. And I think traffic will be better than expected. And if you can get people into the store continuously, that gives you a lot of runway for a company that was 15 times earnings a few months ago.
Yeah, and then, let's talk a little about this, what you wrote about this kind of this anomaly of some of these stocks that have worked and we're coming in, just kind of what we just talked about Target. We talked about, retail's boring underneath the hood. There's been some really good ones. So, but average one isn't great. So we're talking about dispersion. Let's start with Abercrombie.
Yeah, Abercrombie is it. I honestly wish I could trade this. I'm sure there are people who make an entire living just trading a chart like this. There's absolutely no real economic reason that you can think of that would change the value of a $2.5 billion company by $1 billion twice over the course of a single year. It's a story that people really have no idea on. And they've had the same management the entire time. It caught fire. It went parabolic years ago and got up, to 200 or so, and no one's known what to do with it since. But the Abercrombie story is really simple. They're two different chains. There's the eponymous Abercrombie chain that everybody knows about, those spritzer people. And then there's Hollister, which sells to the lower end. If you're in discretionary, all we've heard recently, and the big change recently, has been that on the lower end, people are spending more than expected. That K economy thing turns out to be just kind of bullshit. And so if the consumer is spending everywhere, well, it becomes, if not a huge long idea, Abercrombie's at least not a short. It's down something like 15% since, 10, 15%. I mean, you see huge moves in these things since I printed this chart. They're going into earnings in the next couple of weeks. There's going to be just enormous moves. It's at least a trading idea that these guys are probably doing better than the expectation. And again, you don't see moves like that in grown-up companies. I mean, this company itself is like 150 years old. It started as like a fish and bait shop in Boston. It didn't become creepy until 30 years ago. It's a very old company, and people are kind of doubling it over the last few reports. That smells like opportunity. I'm not sure which way to trade it, but you see a lot of retailers that look like this, and fish and barrels spring to mind.
Okay, so Abercrombie straddles on the menu. Let's have a look at those. We'll price those up for the show notes.
And then, I see this ripping, and you say unstoppable home goods rally, but in the light of this, it's not like Home Depot's done well, has it?
Home Depot's been a train wreck, but Home Depot's, there's a subtle different market for all these companies, and Lowe's has been a little better. Williams-Sonoma is just kind of doing something different. We talk about this all the time, and primarily kind of in the context of restoration hardware, because I love the rivalry between Laura and Friedman, and it's kind of fun that they don't like each other, and there's scuffling that goes on between the two. But restoration hardware is kind of reckless and crazy with the numbers. Williams-Sonoma has just beat quarter after quarter throughout all the stuff that we talked about at the top of the show about, first the tariffs coming in, then a war that no one needed. This company is just come in, beat numbers, raised guidance conservatively enough to beat numbers again, and done it for a year and a half, 2 years straight. It's kind of the best management in the business. I'm not sure what to do with this as a stock. I have kind of been perennially buying dips, but this is a little bit like where Target is. The 52-week high, it's kind of breaking out. That move is clearly not sustainable. I don't know how people react to that into the number, but we've seen a few stocks, and particularly in the restaurant space, that were up 50% going into the number. They reported cromulent numbers, to quote The Simpsons. They were fine, and saw big, gains going on. I think these are it's an underowned group in a world where you don't want to just be piling into AI.
So Jeff, I want to talk about stocks that you like that aren't up 50% since May.
Sure.
So is there anything in that category as we head into the season?
You know what I've been wrong on are kind of the smaller cap. I thought this would be a great year for RealReal. Because we've seen some pretty good action in luxury. We've seen a decent, there's a thin little kind of needle eye they have to thread, which is people that are willing to spend but aren't doing it to show off to their friends. And RealReal kind of threads that. They put up pretty good numbers. The stock has not been great. They reported last week, and it was fine. It was good. It wasn't breakthrough. You're not seeing traction in sort of stories. What Wall Street seems to be favoring right now are just, it's not really the rate. It's not really how huge the improvement is. It's just a matter of direction. They just want, if earnings are improving a little bit, if you have a coherent plan as a turnaround artist, you're getting a lot of credit. So, Starbucks is a company that I like. That stock hasn't been great. Benny and I have talked about it for a long time, where there's no compelling valuation argument other than they're going to be better than they were before. I don't know where to value that. I'm not sure what that translates into earnings, but I know they've stripped out kind of the Chinese operations. They've improved the same store sales. They're seeing traffic up without raising prices, and they solve food. That's a lot of turning around that company's done. So even though the multiples look high and the stock hasn't really behaved, I think people are going to still start buying it now. I mean, there's still opportunities out there. It's just, you're catching kind of lightning in a bottle with some of these moves. I mean, my son and I literally went to Victoria's Secret, the mall. I made him go through there, Squirrel. I'm not going to lie to you, mostly just to kind of embarrass him, because he's just kind of like, he's a big Navy guy. And it's like, you want to see what daddy does for a living? Okay. Try to seem calm, we're going to walk into Victoria's Secrets and we're going to check out what's going on in this store. Now, it's, I don't want you to look at the girls. I don't, there's going to be a lot of frilly things. I don't need you to picture that. We're going to just see how this operates as a store. And he's laughing and like, there's nothing funny here. I was Denzel Washington, the kid, I'm just like, God damn it. Stop laughing. This is what I do for a living. We bought this stock the next day. Entirely because of what we saw in the stores, because they're executing on a level that no one thought they could. Super popular short. People love to short that stock. They hate that stock. They didn't think the CEO could do it. Benny put it in the slide. Is a woman who changed the ticker to V sexy. That is a career bet. That is just that is the squash, the donkey balls it takes to just we're going to change the ticker to V sexy. This up 80% since she did it. She's doing what she said she was going to do. It's audacious. That's what Victoria's Secret should be. It's kind of trapped on a lot of older investors' mind space as a really creepy Epstein related company, and it's just not anymore. I don't know what a fair value for it is. I know I'm still long it and I don't want to sell it. I wouldn't buy it here. I'm just kind of afraid to move because it kind of deserves the premium that it tacked on. It's really hard to find companies that have that sort of overhead space in terms of being better than they were before. It's just not a brand new idea.
They were really bad though. I bought that in Liberation Monday at like $14-15, somewhere in there. And it was like, okay, these guys, they kind of got away from product, and then they went on to the whole woke thing. Didn't really ever make sense. They changed their tune, kind of like Budweiser and Target were like, they found Jesus as well. But really the product, I talked to my girlfriend and talked to other women about it. I was like, they kind of got away from it the way Lulu did, right? Like I used to love Lululemon shorts, and I was in there recently because I had $100 gift card, and I just didn't find. I used to be able to find stuff that I liked super easily.
You could buy one sock. You could buy one sock for your $100 gift card, right?
Yeah, I mean, but I guess my point is that like, at the end of the day, sometimes it's just as simple as you got to keep making product people want, and not go away from that.
And have a sense for it, and they got away from sort of the creepiness that was kind of inherent and built in that store. It was shocking. Who nailed the bottom in this? I think it was October of 25. It was Sophie Cunningham, who, when they announced that the TV show was coming back. Now, we're old enough to remember that TV show went off ingloriously. It used to be a huge, big deal that Victoria's Secret was doing a show. They showed increasingly disturbingly slender models and huger wings. It just became creepy and all coked up and terrible. To see someone who was young and literally iconic, and she was like, sign me up, make me an angel. It's been my lifelong dream. It's like this brand has changed. Abercrombie did the same thing. It trades at a huge discount just because of all the entanglements it had before. Once you get rid of that, it's great. And so, Victoria's Secrets is being run by, a power woman who actually can execute and is making better product and making the stores kind of a cleaner, safe, nice place to shop. Once the big meathead son got over giggling at the idea that I was making him go into an underwear store, he realized that, this is a really nicely stocked store. Everything's organized. Everything's kind of well sorted. There's a lot of traffic. There's just the right number of customers at the counter, which is to say they're going through the turnstile. It takes about 5 minutes. They've got things that they can pick up that as extras on their way through the turnstiles. That's perfect. And everyone greets them and bags up and says thank you. That's all you think. That's fantastic for a company that does what, $9 billion in a $15 billion industry, give or take, whatever. I'm not sure what the margins are, but there's it's just a nice business if you can actually address your customer, and they figured that out, and that's huge. So you're right, Benny. They got the product right, but they also got the execution right, and they cleaned up the stores. I don't know where the top is. I mean, I'm not recommending a stock that's done this well. I'm just telling you what to look for when you're kind of searching for
I was
stuff
just
to
going to
shop.
say that, Jeff. There's I mean, there's a theme here, right? You call bullshit on consumer confidence basically last year pre Black Friday, right? And you absolutely nailed that. You own a lot of stocks that have done well. Some of them are up massively, and you're kind of, I'm not sure I can chase them here, right? So yeah,
so where do you go, right? Like,
where do you go?
Give me
Where do you
something I can
go,
make
Jeff?
money from.
Because
So let's talk about what we're looking at. Here's what I get the biggest
what we've learned
question
before
on.
is
Nike's a question that I get all the time. That's that 52-week of multi-year lows, right? It just kind of is asymptoting at 40. I don't have the chart in front of me, but I believe that's pretty much where
41.
it is. Yeah, and that's just kind of where it's sticking, and that was low before, and everyone thought that's going to be fine. People are waiting for a turn there. That's going to be a turn if they get a new CEO, again, with a plan that's coherent and proof that he can execute it. There's a lot of places Nike can go, but just undoing the mistakes of the prior era, that's not the answer. Now you can sit in Nike as dead money. I don't know where that bottoms. I don't think the next quarter is going to be great. It's Lululemon's a similar one. We have a CEO coming in September. She used to work at Nike. As a hire, it's not dissimilar than what we saw with Fidelity at Target, where you got an 80% rally because it proved to be a much better hire than you thought, right? Like the board was more competent than you thought. It seems crazy for the Lululemon board to have hired someone 6 months ago who used to work at Nike, who Lululemon made all their bones kicking the crap out of for years, as a CEO, and she can't even start work until September. That seems nuts. She has about maybe 4 weeks, maybe 5 weeks to come in there and just go Godfather. Just announce her presence with authority. Just take out the heads of all 5 families, and do something just radical, distinctive. And you know what? There's a new sheriff. Here I am. If she does that, that stock's going higher. That's a really easy sell. Then you've got narrative, you've got improvement over multi-year digression of operations and just kind of a diminishment of the valuation of the company. And reputationally, you can't possibly get worse than they were. If you really catch a hot streak, it can go much, much higher if they actually figure out a way to mass produce stuff people wants again. None of that stuff has happened at Nike for 5 years. They've been tortured. That stock as low as it is. So where do you find the turnaround? You got to wait for it. It matters where you actually buy these things, because on the course they're going, unless Nike actually applies some pressure to the current CEO, who again was hired just to undo the mistakes of the last guy, that turned out to be profit neutral as an exercise, and they've lost the zeitgeist in the meantime. But it's a $40 billion empire, and so that's a huge buy. Is it a buy right now? Nope, not yet. Is Lulu a buy right now? Nope, not yet. You don't have to catch the bottom, and you're never going to catch the top. But miss 12%, miss 20%. Let them have 2 quarters. Don't be afraid to chase a little bit. There's so much space on a company that has been just destroyed in value the way a Nike has, the way a Lulu has. And it's a beautiful setup for anyone who's a contrarian, because every time you buy it, people are going to just tell you how it was once a $500 stock and you're an idiot and it's never coming back again. And if you're actually listening to a really good manager fix a lot of things that are really obvious in a company, get me long and just let me go to a desert island. Like, let me go someplace where I don't have to pay attention to day-to-day stock moves and just let it work.
Yeah, I mean, it's definitely can't have much worse sentiment than it has right now. I mean, it's been multi-years for, Lulu, Nike, like they were post-COVID, darlings, been good brands for a long time and really had a couple tough years. So I'm with you that if you look at Target, that was right in the same boat last year for multi-year. And look, that's been a good stock, right? So
it's been a good stock because they have a plan, they have an idea. Look at shoes. I mean, shoes is another space just more broadly than just Nike. If you look it up, there's Crocs. Deck is basically breaking even for the last 3-4 years. and everyone else is kind of a train wreck. Kind of a disaster. OnCloud blew up. Like, that was hideous. That was a destruction. Are there going to be values there? For sure. On came out way too, they've been public for 8 years. They were overvalued when they became public, probably getting closer to undervalued now. But man, don't try to catch the bottom. Let them show you the profits in advance. Let them show you how they're going to actually behave.
Yeah, kind of like Crocs, right? Like Crocs is kind of the same thing. It had a good number. Now it's been pretty good stock since the Q1, basically. It's up, what, I don't know, 130, 135 now. It was in the 70s, late, early or low 80s. So I guess the general theme on all this is that in a sector that's kind of going sideways, that doesn't have a whole lot of secular headwinds or secular tailwinds behind it, it really is a stock picker's market, if you will, but it's kind of amplified because when they move, they really move. So, how do you think about position sizing? We're talking about these stocks that are ripping like that. And people hear this, like, how do you think about that? Just for your own, you don't have to say exact numbers, but like, what's the general thinking?
I mean, the general thing is you're going to have kind of fewer numerically good ideas. And so you need to optimize your profits out of each of those, which involves rolling up options and staying long and texting the hedging the shit out of everything. Is that, super like kind of judicious? I don't know. It's you're talking about a sector where 60% of the shares are down, 40% are higher, and there's just this kind of that endless pump towards the good ideas because that's where the numbers are. And so you try to stay kind of limber on your toes, but what's working is working. So you scale down in terms of any leverage and you just make sure that you're locking in profits along the way higher, but you have to stick with good ideas. If you're waiting for the fundamentals to turn less than the stocks. And this comes from someone. I was long Etsy, I was long Peloton, I was long Lulu. I've been long a lot of stuff that went boom. And you're not trying to catch the top. If you miss the top 20%, that's just fine. You're looking to get the hell out of Dodge, and you're looking for, just safe. And once the fundamentals turn, that's kind of when you ditch. And so position size is, I'm not trying to vibe code it, but there's not some magical formula. There's just, as long as these stories are getting better, it's once they become winners, then it makes it a lot easier. When you're on the margins, I've been long real for a while, waiting for it to work. It hasn't worked. It's those are ones you got to cut bait on and focus on kind of sticking to stuff that's actually showing some activity that makes sense. Again, on a fundamental basis, narrative basis, technical. If you get all three, man, that's the Yahtzee zone.
the Yahtzee zone. One thing you talked about, we can kind of transition to, is restaurants and what's going on in restaurants. We haven't, the squirrel, I kind of negative-ish on it for a while. Kind of what's going on. I know you mentioned cake.
It was a good short universe for a while. Less so now. We talked about with Cracker Barrel and Cheesecake Factory. They've been roofing it recently.
What about our friend Dave and Buster's? That's at the COVID low. It's left for dead. So should we be bottom fishing there?
That seems like one of the have-nots. The most CapEx intensive one with the endless rotation managers. It's you're right, Squirrel. You were on these as a short for a long time. Dead right. Right now, less robust, and you're seeing just unbelievably vicious squeezes. Cracker Barrel never should have been down this much in the first place. They kind of got accused of being a bunch of woke stuff that they really weren't. Cheesecake Factory's numbers.
That was the most amazing narrative tennis, the Cracker Barrel stuff.
Right.
The logo. That was just the most absurd. One of the most absurd sort of culture war stories of 2025.
The idea that people were organically angry over getting rid of the logo. Drunken old man sitting next to a moonshine barrel in front of the store. That was a real problem. The CEO ended up getting fired for it. So she left, and now the stock's up 150%, 160%. I mean, it it was kind of short manipulated crap in the first place. Does that make Cracker Barrel like a growth chain? Not really. It's going to asymptote. So it's a guitar string. You pluck it really hard, it went way, way down, and now it's just going to kind of vibrate. It's back to somewhere where fair value is. But it's what makes it done as a short idea squirrel is that they've been annihilated, and right now we're seeing both ends of the consumer kind of going out to eat. And so you'll find one-offs like Shake Shack. I'm not sure what their raison d'etre is. Like, they need to define that. And that stock has been a great short, but you can kind of be a mediocre story in this group and still do okay just with the tail end of the consumer being a little bit better than expected. As they are, if you see people going to Chili's and Cheesecake Factory, Chili's is $80 and Cheesecake Factory will run you $400 to take a girlfriend or whatever. That's a big difference. That's a big swath of America that's going out to eat. It's a tailwind. They're coming off kind of a couple negative years, and that's just made kind of this group untouchable from the short side, and the longs are just kind of the better bet overall.
Sorry, let me pause you. Did you say dinner for two at the Cheesecake Factory will set you back $400?
Have you priced the drinks there? You're paying like $40 for it. It's you want the Agave Volcano with the blue grenadine. Like it's come on, man. They say you. That's the entire business model is to get you hammered on like $50 drinks, which just the idea of $50 drinks sounds wrong for me saying that out of my mouth because I'm old enough to remember that would be unthinkable when I was doing these type of party things. Not now. So sure, yeah, that is in fact what it costs to go out and have yourself a night at the Cheesecake Factory and make sure your day ends well.
Yeah, it is kind of amazing when you go. Like, I was just traveling in the airport. We were at Margaritaville, and it was like $200 for two of us, and it was like, and maybe there's an airport premium in it, but like I would say, alcohol at restaurants is definitely doing the heavy lifting. Let's put it that way.
Always
just lugging around.
I grew up in the restaurant business. All of the gross margin came from the booze bill, right?
And it's apparently these are the only places on earth where people are still drinking. Like, for all you hear about how GLP-1s, no one's drinking. Oh, geez, this is the healthiest generation ever. I don't know. It's hard for me to see Cheesecake Factory kicking ass to quite this degree unless the bar bill is doing some heavy lifting there. So somebody's drinking.
And one more that's been left for dead was Chipotle. Any change of thought there? Because you were definitely like pushing for Starbucks when it was kind of rolled over, and Nichols got that huge premium right off the chute because he was so great when he was at Chipotle. And now Starbucks is starting to work a little bit. But like, is Chipotle the next one of these ones that it's like Nike, Lulu, Chipotle? Just kind of their sentiment can't really get worse than it is currently, or is it?
Chipotle is missing the narrative. They're missing the part where they tell you why this is going to be fixed over time. What Starbucks has and Chipotle doesn't is, okay, this is how we're going to make it more profitable. Starbucks fixed breakfast. It's Howard Schultz was chasing around breakfast like a white whale for 45 years, trying to figure out how to make food at Starbucks. And Nichols came in there and fixed it in like an hour and a half. He's like, what we're going to do is just make stuff that you put in the little cooker there, and it's going to come out nice, hot, and fresh, and we will serve it to people in 3 minutes. It was done. He set a 4-minute standard. He's a smart guy with a plan that people will follow. He solved the union problems. No one's bitching about Starbucks anymore. They don't have problems with people hanging out in their bathrooms anymore. Remember, Starbucks spent years and just unbelievable amounts of wasted energy debating whether or not like homeless people should be able to use their bathrooms. Excuse me, madam, but this is a place of business. Like, what the hell are you doing? They managed to kind of fix that pretty fast. That's a good CEO. Chipotle still has sort of the leftovers of Nichols. So I'm not sure. Again, that's a good example of not having to catch the bottom. Could they work? For sure. God knows the stock has been beaten down like crazy. I don't have to catch the bottom on that. I can still get 50%, 20% from here if it's actually fixed.
they still feel pretty expensive to me, right? Even after the derating. I mean, I'm looking at the team slot bowl, so sort of Carver, Chipotle, right?
Yeah.
To be clear, I'm short both. Not financial advice, but I mean, they've got a lot more than narrative to conquer, in my view.
Well, they've got narrative to me includes things like we're going to cannibalize our own restaurants by opening restaurants really close to the existing ones, and then that'll fix itself. I mean, there is no larger red flag in all red flagdom than we're just going to go ahead and steal business from our affiliate stores. I don't care if you're franchising. I don't care kind of how you're building. The idea that drive-throughs would be the fix. The idea that the market for 1,400 calorie burritos hasn't been kind of sated. Like there's a lot going wrong there that I don't want any part of it. I don't disagree with your short at all. It's eventually be a buy, but just it's a not yet. There are 5,000 stocks out there. We don't need to buy Chipotle.
A lot of these fast casual, a lot of these fast casual and chain stores sort of talk a lot about their digital strategy and their sort of loyalty card stuff. Do you buy into all of that? Is that really driving footfall for? I can see why in a coffee bar you've got your Starbucks loyalty card, and you smile when you get your free 5th cup of coffee on a Friday, right? But are we really? Is that really a key unlock in terms of growth for some of the fast casual chains?
No, the unlock in terms of investing is that Starbucks has actually rallied some 40% since they de-emphasized those store cards. People hated those effing store cards. People freaking hated them. Like Starbucks for years was measuring the success on how many customers signed up for these cards that you literally could not sign up for. You couldn't get your coffee. Turns out that there was something like 25-30% of the transactions were never fulfilled by people who used the app because the system wasn't set up for it. It was a ludicrous kind of measurement. It's Squirrel, you touch on an important point because it's people talk a lot and they kind of criticize, and it seems like vibe coding or just intellectually light to spend so much time in the stores and basing what your investment opinion is on them. But you can kind of tell when you go in what ideas make sense and what don't. The cards are a good idea. If you have people grumpy both in the pre-order line and the waiting for coffee line, as Starbucks did for literally years, where people would try, you couldn't be a walk-in customer because you didn't have your card and everyone had pre-ordered. You couldn't be a pre-order customer because the app was shit and you couldn't, and like competing with that is Nichols delight. Like that's beautiful. I want to compete with a company that operated that way before, because what I'm going to do is serve them nice warm coffee inside of 4 minutes. And I'm going to make sure that everyone in the damn chain knows that, because I'm going to rant like a psychotic animal every time I walk in. I'm starting the clock. It's 4 minutes since I ordered. For the love of God, serve me my coffee within 4 minutes and have the right name on it. And that's all I ask. That's all I want from you. Beautiful. That's what Nichols done at Starbucks. That can go a super long way. Chipotle doesn't have that. They've got Chipotle drive-through burrito stands. They think that's going to fix it. It's their CEO is talking about how if you weren't satisfied with your serving size, just ask your server for a little more. He actually said that on national TV. This is not a person who's ever either worked in or eaten at a fast food restaurant, because that just sounds like a version of hell to me to have people. Yeah, it's you need
see Oliver Twist strategy.
Right. Yeah. Please, sir, some more. Okay, I'll give you a little scoop. It sets up a weird dynamic that slows down service quite a bit. It's flawed on a number of levels. And that's what Chipotle is missing. But not all change is good, but a CEO with a good strategy can fix a lot of errors in the company for a couple of years. They get a nice long honeymoon that is investable. Yeah, they just got to prove that they're coherent, that they're smarter than the last guy. Chipotle doesn't have that yet.
Yeah, so in general, I think the takeaway is that, like, hey, if you can just figure out how to run your business the way the consumer wants it from you, the stock will probably take care of itself. Overall, you're not getting the boost. There's not consumer excitement at large. So you need to go prove it, gain some share, prove the short strong, get that boost. That's, blocking and tackling more than, some super sexy
It's the
story.
timing of companies that have been left for dead. It's the Tillys of the world, the Targets of the world. It's a Walmart's not going to get you where great expectations were built in somewhere along the time that it doubled. It's let's find some undiscovered stories on a relative basis and let's ride those ideas as long as the doubts persist. So, Target's still heavily shorted. Victoria's Secrets is still heavily shorted. Give me some of those.
Perfect. All right, Jeff,
boys.
we hit the top of the hour. Listen, before we go, where can people find you? I know that you're everywhere, media. But say again. Sorry, I interrupted.
Stock Market Media. Find me right there.
Perfect.
All right.
Well,
thanks, buddy.
Well, listen, thanks for coming back, Jeff.
All right, boys.
We watch with interest. Thank you. Well, that's Benny, Squirrel, and the Macke out.